Good morning. Today, the artificial intelligence rally faces a different kind of test. The question is no longer whether AI demand is strong. The question is whether strong demand is still strong enough to justify prices that already assumed near-perfect growth. That distinction matters because great business results and falling stock prices can happen at the same time. First, let's separate the facts from the interpretation. On Thursday, July 16th, the S&P 500 closed at 7,533.77, down 0.51%. The Nasdaq Composite fell 1.47%. The Dow declined 0.2%. But the sharpest pressure appeared in semiconductors. The PHLX Semiconductor Index dropped 4.29%. Then, at 4:55 Eastern Time on Friday morning, the pressure continued in futures. S&P 500 futures were down about 1.03%. Nasdaq 100 futures were down about 2.05%. Dow futures were down approximately 0.67%. Those are two different market snapshots. The first describes Thursday's completed regular session. The second describes Friday's early pre-market conditions. They should not be treated as prices from the same moment, and pre-market levels can change quickly before the opening bell. Now consider the fundamental evidence. TSMC reported second quarter revenue of approximately $40.2 billion. The company projected third quarter revenue between $44.6 billion and $45.8 billion. It also indicated that full-year revenue growth in U.S. dollar terms could come in slightly above 40%. And planned capital spending remained extremely large, between $60 billion and $64 billion. Those numbers do not look like an immediate collapse in artificial intelligence infrastructure demand. But strong demand does not automatically produce a higher stock price. A stock does not trade against whether a company is simply doing well. It trades against what investors had already expected. Imagine that the market has already priced in exceptional growth, expanding margins, uninterrupted capital spending, and almost flawless execution. In that environment, a company can deliver excellent results and still disappoint the market. Not because the business is weak, but because the expectations embedded in the price were even stronger. That is, the expectations reset. The current semiconductor decline could reflect several forces working together. High valuations leave less room for disappointment. Crowded positioning can accelerate profit-taking. Rising bond yields can reduce the present value investors assign to distant future earnings. And when a trade has performed exceptionally well, even strong results can become an opportunity to reduce exposure. This does not prove that the AI cycle is over. It also does not prove that every AI-related stock is safe. The evidence currently supports a more careful conclusion. Artificial intelligence demand still appears strong, while the market is becoming less willing to reward strong results automatically. At 6:55 Eastern Time, the U.S. 10-year Treasury yield was around 4.551%. The dollar index was near 100.69. Brent crude traded around $84.75 per barrel, while West Texas Intermediate was near $79.80. These conditions create another layer of uncertainty. If oil prices remain elevated and inflation pressure strengthens, bond yields could stay higher for longer. That would create an additional valuation challenge for high-growth companies. But this is a conditional path, not a guaranteed chain of events. Oil does not automatically determine inflation. Inflation does not automatically force yields higher every day. And higher yields do not affect every technology company in exactly the same way. The market must confirm each step. So, what should investors watch next? There are three scenarios. The bull case begins with stabilization in semiconductors. Chip stocks would stop making new lows while evidence of strong AI demand, data center investment, and capital expenditure returns to the center of the market's attention. In that scenario, the recent decline would look more like a positioning reset than the beginning of a fundamental breakdown. A constructive signal would be improving market breadth. That means gains would extend beyond a small number of mega-cap companies, while software, industrial technology, power infrastructure, and other AI beneficiaries begin participating again. The base case is continued volatility without broad contagion. Semiconductors could remain under pressure as investors debate valuation and future returns. But the selling would not spread aggressively into software, cloud infrastructure, large technology companies, and the wider group of expensive growth stocks. In that scenario, the market would be resetting expectations inside the AI trade rather than rejecting the entire growth outlook. The bear case begins when the selling broadens. If weakness moves from semiconductors into large technology companies, software, high-valuation growth stocks, and the broader market, the interpretation changes. That would suggest the issue is no longer limited to profit-taking in one crowded industry. It could indicate a wider reduction in risk appetite. The most important warning signal, therefore, is not simply whether one chip index falls again. It is whether the decline spreads. Watch market breadth. Watch whether companies with strong earnings continue to sell off. Watch whether treasury yields remain elevated. And watch whether investors begin reducing exposure across unrelated growth industries. There is also an important invalidation test. If semiconductor shares stabilize, selling remains contained, and strong demand indicators continue without major cuts to capital spending, the broader bear case loses credibility. But if companies begin reducing AI investment, revenue guidance weakens across the supply chain, or selling expands throughout the growth market, the idea that this is only an expectations reset would need to be reconsidered. Today's market is not delivering a simple message that artificial intelligence demand has disappeared. It is delivering a more demanding message. Strong growth is no longer enough by itself. Companies must now outperform expectations that were already extremely high. That is why great results can produce a weak stock reaction. And that is why the next stage of the AI rally may depend less on exciting headlines and more on valuation, execution, market breadth, and evidence that investment is producing durable returns. The key question today is not, is artificial intelligence still growing? The better question is, how much future growth has the market already paid for? Until that question is resolved, expect volatility to remain high. Focus on the difference between facts, interpretations, and scenarios. And remember that a falling stock price is not, by itself, proof that the underlying technology cycle has ended. His is market analysis, not a recommendation to buy or sell any security. Thank you. See you tomorrow.